Good morning from cold and cloudy Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money biweekly podcast. Today is Sunday, May 3rd, 2026. Since I was with you last, exactly 2 weeks ago, the U.S. stock market has continued a strong upward trend with the S&P 500 and the NASDAQ Composite Index both pushing to fresh record highs and extending a multi-week rally. The strength has been driven primarily by robust corporate earnings, particularly in large cap technology and AI-related companies, which have exceeded expectations and fueled investor optimism. At the same time, the markets have been navigating cross-currents, including rising oil prices tied to Middle East tensions and higher treasury yields, which have created intermittent volatility but have not derailed the uptrend. Overall, the environment reflects a resilient, earnings-driven bull phase with broad participation and momentum remaining positive despite macro risks and fading expectations for near-term Federal Reserve rate cuts. In just a couple of minutes, we're going to look at some key charts, some important data series, and some of Asbury Research's own data-driven models pertaining to what is going on in the markets right now and the sustainability of this really strong uptrend that we've experienced during the month of April. But before we do, let me take a minute or two to tell you a little bit about us. Asbury Research is a registered investment advisor. We've been providing investment research to both individuals and professional money managers since 2005, which makes this our 21st year in business. We utilize what we call intelligent diversification as opposed to static diversification, or what I call set it and forget it investing, which is really typically the standard allocation program for most advisors. It is typically based on, it's built around a static 60-40 stock and bond portfolio, maybe with some precious metals and international equities sprinkled in there for some further diversification. And it's for the purpose of trying to protect you under all market conditions, whether the market's going up, down, or sideways. The problem with the strategy is that it just doesn't work very well because, similar to old-fashioned cruise control in your car, some human intervention is necessary to keep you from killing yourself. For example, both stock prices, bond prices, and gold prices aggressively declined at the same time throughout the month of March. If you prefer to manage your own investments, we have 2 levels of research service available. Our flagship, Asbury Premium Research, is for more serious investors and includes the latest updates on all of our models. You can find out more about this service by clicking the Research tab right here up the top of asburyresearch.com. And you could request further information from us, including an informational Zoom meeting if you like, by going to the Contact tab. We also have an entry-level Substack newsletter right here at asburyresearch.substack.com. It's $25 a month. It does not include all of our trading models. It does have one quantitative model built in there called the Sort Report. But again, it doesn't include our CPM or our CEF models, but it offers selected reports and models from our premium research service about 3 or 4 times a week. There's also a free version of the Substack newsletter. So if you like the videos, if you like our approach to markets, but aren't ready to start with a paid service, I strongly suggest that you sign up for the free version, and you could do that right here again, asburyresearch.substack.com. Let's go back to the premium service. If you prefer a managed account rather than being a do-it-yourselfer where you want to pull the trigger on your own trades, we have created 4 model portfolios using our own proprietary models like the CPM model, correction protection model, and the CEF model as building blocks for the purpose of participating in the market with less downside risk. That's kind of what we do the best here. I think a lot of that has to do with my age. I'm an older investor, and once you get into your 60s, the game changes. If you're in your 60s and you're still investing, you probably have a lead. So like in football, once you get to the 4th quarter, you play the game differently. You're not taking a lot of chances anymore. You're giving the ball to your big fullback, and you have your eye on the clock and you're trying to score again if you can, but you don't want to take a lot of chances. I think that's where I am in my investor football game, if you will. And that's really what we're good at, is either giving you the market with a lot less risk or giving you market risk with better performance. These model portfolios have all been developed through rigorous 8-year back tests and have been trading in real time now for almost 2 years by both individual investors and also RIAs, professional money managers. If you'd like more information about the model portfolios, you could click here on Managed Accounts and just kind of follow it down. Select the portfolio or portfolios that you're interested in. Caveat, full disclosure, past performance does not guarantee future performance. And also, full disclosure, all of my own equity-related investment dollars are all in these various Asbury Research models. So we're eating our own cooking here, and we're doing that because, frankly, we haven't found anything better. Our models really do a good job of allowing investors to be able to participate in the markets with a lot less risk. Okay, now let's get to the reason you're here, and we're going to look at some charts, data, and some of our own models. So we're going to go to the Research Center. This is the paywall. And we're going to go down to the Asbury 6. The Asbury 6, whenever I do interviews, I'm on the Schwab Network once a month, Fidelity Investments, Investors Business Daily, and others. We're kind of known for the Asbury 6. So here it is. It's all green right now, which means the market internals are as bullish as they can be according to this particular metric. It's meant to be an indicator rather than a model. It's a daily indication of the broad market's internal strength. The way I like to describe this to people is what this is meant to be, and this is done at the end of every day, and it's posted to the Research Center, the premium part of the website, about 2 hours after the market close every day. We look at it as an EKG for the market's internal health. We want it to be sensitive because we want to know when that health is starting to fade. And that would be if 1 or 2 or 3 of these start to turn red, the internals are starting to break down. And it gives us kind of a heads up as to when we should start to change our approach in terms of the research that we produce and how we look at markets when we see the internals starting to break down. After being negative as of March the 6th, let's scroll down a little bit. After being negative as of right here is March the 6th. This is the S&P 500. This is daily going back to April of last year. It went back to positive on April the 6th, and it's stayed positive. It's been all green now for probably at least a week or so, and the market's up about 10%. The S&P has risen about 10% since April the 6th. Look, with an 8-year look back, it's underperformed the S&P by about 2% on an annualized basis. But the maximum drawdown on the A6 has only been about 13.6% compared to almost 34% for the S&P. So about 2/3 less of a maximum drawdown. It's about 9 round turns a year. So in other words, it's going to go from positive to negative about 9 times on an annualized basis every year. And again, it's a part of our premium research subscription. Here's why drawdowns are so important to us. The way the math works, if you draw down 20%, you need to make 25% back the other way in order to get back to the peak of where you were. The one that I always use for an example, because it's something that we've gone through not too long ago, when during COVID, during the really sharp decline that we had, that was the early part of 2020, the S&P dropped 34%. So here, if the S&P drops by 30%, we need to go 43% back the other way in order to get even or get to where we were at the top of the last rally. Get our P&L back to where it was. So the reason this is important, if you're 30 years old, it doesn't matter that much because you're dollar cost averaging. Over the course of the next 25 years, hopefully, you're buying stocks every week, either through your company or just, by yourself, and you're building a nice base, for your retirement or for your future. Once you get older, it changes. Sometimes when the market drops 34%, it may take 3 or 4 years to get back to where it was, and not just a few months. COVID was relatively quick. That is not always the case. So again, like football in the fourth quarter, you don't want to make any mistakes. You want to try to limit your drawdowns here, and that's why we focus on that so much. The next thing we're going to look at, we're going to go back to the research center, and then we're going to go to our CEF model. Our CEF model is our sector rotation model, and there we are. The CEF model is for alpha generation, it's a completely data-driven sector rotation model created to quantitatively identify long/overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sector select sector spider ETFs, which together, if you put them together, that's the S&P 500. And we look at it in multiple time frames. We look at it on a trading week, on a tactical month, and a strategic quarter. So we built an algorithm years ago that measures the velocity of assets, the velocity of investor money as it's moving around these 11 sectors, and we do it in 3 different time periods. So as an example, last week, the fastest money in on a trading basis, which is the past 5 days, was flowing into energy. The fastest money out during that same 5-day period, it was coming out of healthcare. So then we do this for the tactical month and the strategic quarter, and we add them up for the composite ranking of 4. So that was the best on the board over the past week in 3 different time frames. The worst on the board was healthcare. So all we simply do with this model is we're buying the sectors where the market is going, and we're avoiding the sectors where the market's coming from. The CEF model is always fully invested in the market, and it provides investors with a dynamic alternative to the traditional buy and hold portion of your portfolio. According to our back tests, the CEF model has very significantly outperformed the S&P 500 on an annualized basis over the past 8 years, but with a lower maximum drawdown. CEF's been trading in real time now via managed accounts for both individual investors and portfolio managers for almost 2 years. And I've been trading it in my own account for much longer time period than that. In real-time trading through late last week, the CEF model is up 11.2% year to date and is outperforming the S&P 500 by 4.92%. Currently, again, CEF is overweight top 3: technology, materials, and also energy. Now let's have another look at another part of our premium research service where we're picking ETFs. It's our ETF trade ideas. And basically, I wanted to create a quantitative way to go through the 6,600 ETFs or whatever there are there right now. It's right around that much, and be able to go through them quickly, quantitatively, and screen the ones that are checking the boxes for us. And for us, the really important characteristics that we want to look for is we want a positive price trend. We want relative outperformance versus the S&P 500. In my world, if you're not beating the S&P 500, then why do it? You're better off staying in the plain vanilla S&P 500. The third thing is expanding assets, which we're looking at the assets under management in these individual ETFs. The fourth part, and the only part that is subjective, is once I go through these 6,600 through the scan, maybe we come with 10 or 15, I look at them each individually for the best risk-reward ratios based on my experience in the markets for all these decades and spending almost 20 years at the CME, a lot of it in the pit. I have a pretty good understanding of when to put trades on and when to take them off. And a lot of that is just simply don't buy ETFs that are up against resistance levels, and try to buy where you've got some support underneath you. It drastically improves the risk reward. It allows the trade to start to make money almost immediately if you do this right. So the 3-year performance is the next thing that I wanted to have a look at this. So we now have 3 years, just a shade over 3 years. This is real time, 127 trades over the past 3 years, which comes out to about 3.5 trades a month. These aren't by the calendar. A lot of services have a trade of the week. We don't care about the week. We're looking for all of these positive criteria, checking all these boxes, and then making sure the risk reward is right. So you might have 3 trades that are all on at the same time, the way we do right now, and then you might go for 3 weeks and not have any trades based on the market. I don't care about the calendar. Average profit per trade is 1.7%. Maximum drawdown, only 3.7. This is a very minuscule maximum drawdown for trading individual ETFs. And the Sharpe ratio, which you could look this up on Investopedia.com. I'm not going to go into it now, but it shows you a trade in terms of the profitability of the idea versus the risk. It's called risk-adjusted returns, and a Sharpe ratio of 1.3 stretched across picking ETFs for 3 years is exceptionally good. Percentage of winning trades, 53%. You might say, well, John, that's kind of a coin flip, isn't it? Not when your average winning trade is 5.6% and your average losing trade is only 2.6. These are the key ingredients for a stock picking system or an ETF picking system. You have to have more winners than losers, and your winners should be significantly larger than your losers. In this case, our winners are 2.2% larger than our losers. So that's how that works. The next thing I wanted to talk about is just spend a second on our managed account. So we're going to go back here, and we're going to pull up this graphic. Let me make it a little bit bigger so we can see it. There we go. That's much better. So we have 4 model portfolios, as I indicated. Asbury Aggressive, Asbury Balanced, Asbury Conservative, and Asbury Ultra Conservative. They're all here. This is year to date, so starting on January the 2nd. All of them, again, were created using our own models, including the CPM, which is the correction protection model, and the CEF model. All have similar or better defensive numbers than the S&P 500, including lower betas, lower standard deviation, significantly lower maximum drawdowns, and much higher Sharpe ratios. Here's the table. You can see the Asbury Aggressive is up 11.25% for the year. This is through Thursday of last week versus 6.25 for the S&P, outperforming by 5. 3 of the 4 are outperforming the S&P 500 year to date. You can contact us for the fact sheets on each of these model portfolios, or we could set up an informational Zoom where I can explain these to you and show you how to get started if that's what you would like to do. The next thing, I want to go back to our Substack. So here's our Substack here. This is a $25 a month service, our entry level. It has 3 different types of reports. Our first one is Chart Focus, and this is the one that we launched this with. And what Chart Focus is, here's our sort report, and we're going to come right back to that. But first, I want to do Chart Focus. So let's get back to the landing page. And here's our Chart Focus. This is a pretty in-depth weekly overview of what's going on in the market, what we think is important. So we probably go through 200 charts, and we pick out 10 that we think are going to be the most influential for the next couple of weeks. So it starts out with a pretty big summary. It talks about economically what these different movements on these charts mean when you put them all together economically. And we look at relative performance, both globally and also domestically here in the US. And we look at stuff like, here's the support and the resistance levels for the S&P. There are no resistance levels right now. We're at all-time highs. This is the Mag 7 and how it's performing versus the S&P 500. We're starting to outperform again, which is very important for the uptrend. We look at how the S&P 100 is doing versus the S&P 500. We're looking at outperformance in small cap right here. That's important. We're looking at underperformance in the Dow, which normally happens when the market's healthy and going higher. People don't want the Dow. They want the NASDAQs because you get more bang for your buck if the market's going higher. We look at seasonality, and then we look at size and style. What's outperforming on the size and style spectrum? And we also look at what's going on overseas. From December 10th of last year to a few weeks ago, overseas equities were outperforming the U.S. That has turned as of April the 16th. So for those that have some international in their portfolios, you probably noticed you had a pretty good first quarter. Things are starting to kind of revert back to normal now, where the U.S. is dominating everything else. Next thing, let's take a look at the SORT report real quick. This is the quantitative model that I told you that comes along with the Substack part of Asbury Research. What we did is we took a very broad group of different types of ETFs. We've got small cap, U.S. technology, emerging markets, global equities without the U.S., crypto, commodities, crude oil, gold, dollar, and interest rates. And we run a quantitative scan on them for positive trend, positive relative performance versus the S&P 500 or versus their peer, and how the money flows look in all of those. The ones that are green all the way across are the ones that we want to pay the most attention to, because these are the ones that are already going our way and have the necessary ingredients to keep going higher. Right now, it's small cap, U.S. technology, emerging markets. This is updated a couple times a week as a part of this service. Finally, the last part is our rainbow charts. This is a brand new edition. These are the corresponding charts to the CEF model. And if you want to look at that, you could go to the free version. You could just go to asburyresearch.substack.com and you could look at this video. It's an introductory video. It explains our CEF, our rainbow charts and what they mean and how to interpret them. Finally, I was interviewed by the very popular Financial Sense website 3 days ago now, Thursday, April the 30th. It's about 25 minutes long. And I talk about everything from international to gold to agriculture, just kind of a broad overlook of what's going on in the markets now. If you're interested in seeing that, you could find that at financialsense.com, and it's also available on YouTube. So there you go. That wraps up our latest Asbury Research is Following the Money podcast. Our next one is tentatively scheduled for Sunday, May the 17th. I hope to see you then. In the meantime, if you have any questions or want more information on our research subscriptions or the managed account services, you can contact us via the contact tab, which is right up there at the upper right part of your screen at asburyresearch.com. Enjoy the beginning of a new baseball season where my beloved Chicago White Sox, Munetaka Murakami, I'm still learning how to say his name, is leading Major League Baseball with 13 home runs. You don't see that coming out of the White Sox every day, so I've got to brag about it. See you in 2 weeks, and don't forget to like and subscribe. Have a great Sunday.